Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Crispr Therapeutics Ag annual report. Crispr Therapeutics Ag is a gene editing company that provides various businesses and services through its cutting-edge technology. The company's primary focus is on developing gene-based medicines for serious human diseases using its CRISPR/Cas9 platform. The company offers several therapeutic programs across different disease areas, including hemoglobinopathies, CAR T-cell therapies, in vivo treatments, and type 1 diabetes. Its lead product candidate, CASGVY, is an ex vivo CRISPR/Cas9 gene-edited cell therapy for treating patients with transfusion-dependent beta thalassemia, severe sickle cell disease, and hemoglobinopathies. In addition to its therapeutic programs, the company also develops CAR T-cell therapies, including CT-Zone 112 and CT-Zone 131, which target specific proteins associated with oncology and autoimmune indications. Crispr Therapeutics Ag is also working on in vivo gene editing treatments for cardiovascular diseases through its CTX310 and CTX320 programs. Furthermore, the company has developed an allogeneic, gene-edited, hypoimmune stem cell-derived product candidate, CTX211, for the treatment of type 1 diabetes. Crispr Therapeutics Ag also collaborates with other companies, including Vertex Pharmaceuticals Incorporated, Nkarta, Inc., and Capsida Biotherapeutics, through strategic partnerships. The company's services include gene editing technology development, therapeutic program management, and research collaborations. Its expertise in CRISPR/Cas9 technology enables it to provide innovative solutions for treating various diseases, making it a significant player in the field of gene-based medicine. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to remain stagnant. The stability of a company's stock price is often influenced by various market and economic factors. One possible reason for a lack of significant change in Crispr Therapeutics AG's stock price over the past year could be the absence of major breakthroughs or announcements that would impact investor sentiment. This could include delays in clinical trials, lackluster earnings reports, or unfulfilled expectations regarding new product developments. Another factor contributing to stagnant stock prices is market saturation and competition within the industry. If Crispr Therapeutics AG's products or services are not significantly differentiated from those of its competitors, investors may be hesitant to invest, leading to a stable but unremarkable stock price. Additionally, external economic factors such as changes in government regulations, shifts in consumer demand, or broader market trends can also impact a company's stock performance. If these factors do not favor Crispr Therapeutics AG, it could lead to a lack of significant movement in its stock price. It is also possible that the company's growth prospects are being accurately priced into the stock by investors, resulting in a stable but unexciting stock price. This would suggest that the market has already factored in any potential future growth or developments, leaving little room for surprise or volatility. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. Firstly, upfront payments from partners such as Vertex play a significant role in boosting revenue. Additionally, milestone payments and royalty payments on net product sales also contribute substantially to the company's revenue. Regulatory approvals for product candidates are crucial in driving revenue growth, as they enable the commercialization of new products. Clinical trial outcomes also have a direct impact on revenue, with positive results leading to increased sales and revenue. Marketing and commercialization efforts further amplify revenue by making products more accessible to customers. Product candidate development and success are essential drivers of revenue growth, as successful candidates lead to increased sales and revenue. On the other hand, competition in the pharmaceutical and biotechnology industries can negatively impact revenue if a company's products fail to gain market share. Collaboration revenue from agreements with partners such as Vertex also contributes significantly to revenue, while grant revenue from contracts with not-for-profit entities provides additional support. Overall, these factors collectively drive revenue growth or decline, making them critical components of a company's financial strategy. The net income and profit margins of the company have undergone a significant decline. In 2021, the company was profitable, but by 2024, it had become unprofitable due to regulatory challenges, government shutdowns, and stagnant revenue growth. The expected operating losses for the foreseeable future are substantial and increasing. One major contributor to this decline is the CASG-EVY collaboration arrangement, which resulted in a 40% loss. Additionally, increased development and commercialization expenses, particularly on the CASG-EVY program, will continue to negatively impact profit margins. The reasons behind these changes are multifaceted. Insufficient revenue generation, regulatory delays, and high development costs have all played a role. Regulatory scrutiny, public opinion, and potential delays in development and commercialization have also contributed to the decline. Furthermore, uncertainty surrounding patent oppositions and potential loss of intellectual property rights has added to the company's financial woes. The lack of significant revenue growth has been a persistent issue, leading to increased expenses without corresponding increases in income. This has resulted in negative profit margins, which are expected to continue for the foreseeable future. The combination of these factors has led to a substantial decline in net income and profit margins, making it essential for the company to address these issues to regain profitability. The financial performance of the company has been under scrutiny due to its inability to generate positive operating cash flow. According to the latest figures, the company recorded a significant loss in operating cash flow for 2 consecutive years. In 2024, it reported a staggering negative operating cash flow of $142,774,000, while in 2025, this figure increased to an alarming $345,014,000. This trend is a cause for concern, as it indicates that the company's operations are not generating sufficient revenue to cover its expenses. The substantial losses in operating cash flow suggest that the company may be struggling to manage its finances effectively. As a result, investors and stakeholders should closely monitor the company's financial performance to assess whether this trend will continue or if there are any signs of improvement. The company's debt level has experienced a moderate increase from $309.9 million in 2024 to $343.4 million in 2025. This represents a growth of approximately 10% over the course of 1 year. In terms of interest expenses, there is evidence suggesting a decrease. Interest income earned on cash and marketable securities decreased, leading to lower interest expenses. Additionally, the net loss before income taxes has improved from $362.70 million in 2024 to $577.90 million in 2025, which may indicate a reduction in interest expenses or an improvement in operating performance. Overall, while there is no clear indication of significant changes on other pages, these findings suggest that the company's debt level and interest expenses have undergone some adjustments over the past year. The performance of various regions and segments within a company has been analyzed. In terms of regions, the United States and Switzerland have performed poorly, with the former experiencing a decline in effective income tax rate from -1.9% in 2023 to -1% in 2024. Similarly, Switzerland's statutory rate difference also saw a decrease. On the other hand, certain segments have shown improvement. The grant revenue segment has been a standout performer, generating $3,510,000 in 2025. In contrast, the research and development and general and administrative segments have underperformed, with the former recording an expense of $239,872,000 in 2025, and the latter experiencing a significant expense of $26,570 in 2025. The management of the company is optimistic about its future prospects despite facing several challenges. The company's mission is to create transformative gene-based medicines for serious human diseases, which it aims to achieve through its focus on CRISPR/Cas9 technology and cell therapy programs. Management believes that this technology has the potential to create next-generation CAR T-cell therapies with a superior product profile. However, the company also acknowledges that it will continue to operate at a loss for at least several years, requiring additional capital to fund its operations. To address this challenge, management plans to finance its cash needs through equity and debt financings, collaboration agreements, and license arrangements. the company's financial projections indicate that it expects to incur ongoing expenses related to patent reimbursements and third-party patent-related expenses. Despite these challenges, the company remains committed to advancing its product development programs and securing additional funding to support its operations. Management intends to consider additional financing opportunities when market terms are favorable. Overall, the company's outlook and strategy focus on developing CRISPR-based therapeutics and cell therapy programs while navigating regulatory challenges and financial uncertainties. Acquisitions and divestitures are significant business decisions that can impact a company's growth, revenue, and market presence. In the context of the extracted summaries, we can identify 2 key acquisitions and 1 notable divestiture. The first acquisition was the in-licensing of intellectual property from Dr. Charpentier in April 2014. This move likely provided Vertex with valuable research and development capabilities, enabling them to accelerate their product pipeline. Additionally, the company issued equity worth $5,543 million for in-process research and development, indicating a significant investment in its scientific endeavors. On the other hand, there was one notable divestiture. In 2023, ViaCyte, a wholly owned subsidiary of Vertex, elected to opt out of a diabetes collaboration. This decision suggests that Vertex may have reassessed its priorities or strategic direction, choosing to focus on other areas of research and development. The company's financial history reveals a commitment to rewarding its shareholders. One of the key ways it has done this is through dividend payments, which have been consistently made over the years. This demonstrates a strong focus on returning value to investors and providing them with a steady income stream. In addition to paying dividends, the company has also taken steps to reduce its outstanding share count through share buybacks. By purchasing back shares from the market, it has effectively increased the value of each remaining share, benefiting existing shareholders. This strategic move not only boosts investor confidence, but also enhances the company's overall financial health. There are concerns about inventory buildup and supply chain disruption in the production of CASGVY. One potential issue is that Vertex may not be able to increase production to commercial levels in a timely manner, which could impact revenue from CASGVY. Additionally, third-party contract manufacturing organizations may experience supply chain shortages, leading to production interruptions and disruptions. The risk of inventory buildup or supply chain disruption is further exacerbated by the lack of control over clinical development, manufacturing, and commercialization activities with collaborators and licensors. Manufacturing problems, equipment malfunctions, facility contamination, raw material shortages or contamination, natural disasters, including pandemics, disruption in utility services, human error, or disruptions in the operations of suppliers, could all cause production interruptions and supply chain disruptions. Furthermore, there are risks associated with third-party contract manufacturing partners, such as supply chain shortages, failure to provide sufficient quantities of product inputs or acceptable quality levels, regulatory and operational risks. The limited number of potential manufacturers exposes Vertex to risks of manufacturer changes and manufacturing process updates, which could lead to delays in production and supply chain disruptions. Overall, the concerns about inventory buildup and supply chain disruption are significant and warrant careful consideration by Vertex as it moves forward with the commercialization of CASGVY. That concludes the financial summary for Crispr Therapeutics Ag. Feel free to comment below, and I will be happy to answer them when possible.